All right, good evening. Welcome to yet another weekly forum from Smartkarma. Just a little recap. The forum is meant to be a high-impact weekly live webinar, which is exclusive for Smartkarma Plus subscribers. During the forum, we discuss some of the best, highest conviction ideas from across the Smartkarma network. We use this opportunity to dig deep into big themes and also allow our guests to ask questions directly and also give us feedback and suggestions for our weekly sessions. Quick disclaimer, the forum is strictly for subscribers. It's meant purely for informational purposes, does not constitute investment advice. It is the opinion not of Smartkarma, but that of our insight providers. And lastly, Chatham House rule applies. Please take express permission before sharing this on social media or any other platform. Quick look at where we left. Last week, we took a look at International Game Systems, an extremely well-run company in Taiwan that manufactures mobile games, is trading on just about 10 times PE, growing 30 to 40% and giving a 7 to 8% dividend yield. We also examined why the Smartkarma research community was so bearish on PayTM, despite it being one of the most hyped IPOs, and also why this IPO ended up flopping in the end. Third, we looked at Sinopec Engineering, a mid-cap listed in Hong Kong, and a unique special situation where the company is trading below liquidation value. Like this, every week, we take a look at some large caps, some small caps, as well as interesting special ideas from across the platform. The forum recordings are also available on YouTube. If you cannot join in person, you can always view the recording and you can also share these with your friends. So today, we will be looking at these three ideas. We will look at JD.com, a large cap in China. We will look at Appier, which is a mid-cap company that recently IPO'd in Japan. And we will also look at UMS Holdings, which is a smaller company listed in Singapore. Let's kick off with JD. Some of you, or a lot of you, might know JD quite well. This is one of the large e-commerce players in China. The market cap is nearly $120 billion. So it's really a mega cap. This is dual listed. It's got a listing in the US, ticker JD US. And it's also listed in Hong Kong with the ticker 9618. It's very well covered on Smartkarma. Ming Lu is one of our Shanghai-based analysts that looks at it quite closely. And as you can see from the chart of JD, this is a stock that's gone nowhere in the last year. It has actually bounced quite nicely since middle of third quarter, but it still remains well below the highs that we saw in the first quarter. And let's take a closer look at the thesis here now. So JD, as I mentioned earlier, it's an e-commerce retailer, and it is transitioning from just being a retail company to really being a company that's fully vertically integrated, having a very, very well-run supply chain business, as well as service provision end-to-end. JD is also strategically expanding very fast into lower tier cities, which still have a lot of growth. It has been less disrupted by the pandemic restrictions in China. And because of its expertise and niche in logistics and fulfillment infrastructure, it has not suffered from the worker shortages that have plagued some of its competitors. The business is growing really nicely. We saw a glimpse of that in the third quarter. Its revenues grew by nearly 26%. Direct sales by 23%, and service revenues even faster at 43%. I think quite importantly, JD is now starting to break away from the pack. As you know, Alibaba, Pinduoduo, and several others are in this space. But JD is certainly starting to demonstrate the superiority of its business model, its vertical integration, and also the sort of relatively lower regulatory risk. And as such, it's one of the favored names in that space. Moving on to our second idea today, That's Appier. Appier's market cap is about $1.5 billion. That puts it in the small or mid cap category. This stock is listed in Japan under the ticker 4180. It is a relatively new listing. It only listed earlier this year. The stock trades $9 million a day, so it's fairly liquid and actionable for most people. Closer look. So first of all, Appier is a Taiwanese company that's listed in Japan, gets a lot of its revenue from Southeast Asia and a little bit from China and the US. It's a very unique business model. Appier offers artificial intelligence and data analytics products that are focused on sales and marketing. So let me explain that. It offers software that is used by companies to help improve the sales and marketing functions, whether it is prospecting new leads or engaging or retaining current customers. Appier has a solution for you. This is a recurring revenue business with very high quality metrics. What's interesting is this is a company that is just inflecting. It's hitting critical mass and it's starting to inflect. So when we look at third quarter numbers, growth was up about 28%. But more importantly, the company reported its first ever positive EBITDA. And that was a result of margin improvements across the board, faster than expected growth, as well as product improvements. The analysts who cover Appier, they predict that if seasonality patterns hold, the operating profit of this company will climb to about 1.7 billion yen next year. And from 1.7, it'll grow to 5.1 billion yen the year after. So you can see we're about to see a real surge in profitability. They've just broken it even, and they're going to be, demonstrating this explosive growth. Now, none of that seems to be captured in Appier's share price today. If I quickly switch to the platform, this is one of the recent research pieces. And on the right-hand side, you see this share price widget. If you click on the View All Analytics, you will be able to see that actually, despite really good results, the share price has not really broken out. It is not a very expensive stock on most metrics. It's definitely a lot cheaper than a lot of the other SaaS, software as a service companies. So that's pretty interesting. The other compelling thing here is that there is significant untapped potential in terms of addressable market for this company. Only 3% of its revenue today came from outside of Asia, which is predominantly the US market. And it delivered that with just one salesperson. So you can imagine, as this company expands its sales team and really tries to capture a bigger share of the international pie, this could be a very, very, very big business. When we were looking at their presentation slides, they estimated that the total addressable market for them is over $50 billion a year. So this is an exceptionally fast-growing, technology-backed company with a very, very credible management team that's all Ivy League educated, that is very owned, and I would say not very well understood either. Lastly, we're going to move to Singapore and look at UMS Holdings. The ticker is UMSH SP. The market cap here is just over 700 million US. This is definitely a small cap, but it's a liquid small cap. The stock trades over $6 million a day. And Douglas Kim is the analyst on Smartkarma that covers the name. So first of all, UMS is in the semiconductor supply chain. They offer engineering equipment that is used by OEMs that manufacture products for semicon. Hence, if you were to peg UMS to anything, you should be pegging it to other semiconductor companies. Now, it really seems that UMS has come out quite strong out of the COVID crisis last year. Their sales growth is accelerating. We expect sales growing about 46% year on year this year. Operating profit is growing even faster, 53%. Now, when we look at consensus estimates for next year, they actually expect a decline. So, I think this is a case of consensus not really revising their numbers and not really looking at what's happening, beneath the surface. Increasingly, the two key segments that UMS caters towards are starting to do very well. One of them is the aerospace sector. And we know that with reopening happening at the margin, things are starting to look up. We're also noticing that some of the recent acquisitions that UMS did have started to bear fruit. And all in all, the view around semiconductor equipment remains very, very positive. This is not an expensive stock. It trades on about 13 times PE. If you look at some of the other names in the region, names like AEM, for example, they have really broken out. So this could be a name that catches the fancy of investors as they start to realize that the street is underestimating its growth potential for next year. And with that, I'm going to allow attendees to participate in a brief Q&A. For this, you can use the Q&A button on your Zoom application. However, if I don't receive questions in the next 30 seconds, then we will let you participate in discussions on the Smartkarma platform instead. All right, well, we're not seeing questions come in, so we will end the forum for now today. Sorry, we've got one question come in on would we choose AEM or UMS or both? That's a really good question. I guess if we were to consider all aspects, we would probably still favor AEM over UMS, and there are some very significant catalysts that lie ahead for AEM. Including a potential NASDAQ listing. Also, AEM is sort of much further along in terms of value add in the supply chain than UMS. But UMS has lagged in terms of share price performance and is fairly cheap as well. So on those two reasons, perhaps it's a better catch-up trade. But over the medium to longer term, I guess AEM remains a better story given the reasons I've just mentioned. Great. I guess with that, we're going to wrap up the forum. And just one little bit of admin. The forum will take a break in the last 2 weeks of the year, and then we will reconvene in January after the Christmas and New Year break. But I think we still have a few sessions before then, but just something to bear in mind. Thank you very much for participating, and speak soon.